Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 140. On today's episode, we're going to talk about the first half of 2024. What were some of the major investment themes? Do we think they will continue? We're also going to look at an article that came out on how wealthy young versus older investors invest and look at kind of the differences. I think you'll find that interesting. We'll also look at reevaluating your financial goals. How did the first half of the year go for you? Or do you need to kind of make some changes going into the second half of the year? We'll also talk about some books we've read, just different kind of things, kind of pull it all together and just look and see how did the first half of the year go. So get your mind right and let's get to work. Well, welcome back to the show, everybody. I meant to do this episode midweek around July 4th, but I've been traveling. I got sick. I had COVID. So if I sound a little bit different, I am much better now, but geez, COVID's still around. Still very difficult to get over. So as we look here, we're at the end, or not the end, we're midway through the year, which that went fast, right? 2024, halfway over. Seems crazy as it always does. Time just keeps going. So we look here, the market has actually had a very good first half of the year. So just another really good start to the year for most of the indexes. And so we look here, the S&P is up a good amount. You look at the NASDAQ, which is also doing very well, up almost 20%. S&P's up 14%. Dow Jones only up like 3.8% for the year. And when you look at this, you look at the top gainers for the first half for the Dow Jones, which is Walmart, Amazon, American Express, Microsoft, JP Morgan. Obviously, when you look at the best performers of the year, they're going to be tied to AI. So you're going to see NVIDIA, which we have talked about a ton on this podcast, and some of those companies. The top 5 losers for the Dow the first half of the year were Intel, Nike, Boeing, no shock there, McDonald's, and Johnson & Johnson. And so there's a pretty big, Intel, Nike, Boeing, all down 30% or more. McDonald's down 14%, Johnson & Johnson only down 6.8%. So you see that when you see the Dow, you see that there's a huge disparity between the S&P 500 and then also the NASDAQ. When you look at that, and one of the things I wanted to point out here is that Amazon being in the Dow, Amazon's only been in the Dow for just a little bit. It actually replaced Walgreens, who has had a horrible year. My goodness, Walgreens started the year at $26. It's now at $11. 5 years ago, it was at $60, and now it's again at $11. And their quarters come out, they're just horrible. They showed that 25% of their stores are unprofitable. And so Walgreens is actually looking to close a lot of stores across the country. One of the big problems with this, though, is that in many communities, they're the only pharmacy available. So if they shut their doors, then those communities really don't have direct access to a pharmacy, which could have pretty big repercussions for those communities that they're in. So it really does put Walgreens in a tough spot. It's like, okay, this location isn't profitable, but if we leave, then these community members aren't going to have access to any kind of pharmacy. So, but it's just a tough space to be in. We've discussed this over and over again. You see my haircut, I'm bald. If I go into Walgreens, I got to check in with like 3 different people to get behind the cages to be able to buy razors because of all the shrinkage, which shrinkage is the fancy business term for people are stealing from us that companies refuse to say on their conference calls for some reason. So it really is. It's tough. Walgreens, CVS, it is just a tough business to be in. And as we discuss on this podcast over and over again, not all businesses are the same. Not all businesses are worth investing in. And if I told you that, if you were to invest in Walgreens today and you couldn't sell it for 10 years, would you do it? You would probably say no. So, but my point of this is that's the nice thing about like the Dow Jones, the S&P 500. There's certain stipulations for being included in those indexes. And if Amazon had not switched with Walgreens, the Dow would be not doing well at all this year. If that change hadn't happened. So that's kind of the nice thing when you invest in the Dow or the S&P 500 or the NASDAQ, even if you just own the ETFs on those, which would be DIA for the Dow, SPY for the S&P 500 or the QQQs for the NASDAQ. If you just own those, that's just the easy button of investing. You own those. If they make changes, it automatically happens, which makes it easy for you if you're not wanting to pay attention the entire time. So you look at that, and of course, the first half of the year is going to be dominated by AI, right? All the companies that are involved in AI. And it's so interesting. I was looking at an article already from The Economist that discusses what happened to the artificial intelligence revolution. So we're already hearing like it's not too loud yet, but it's already like, when are we going to see artificial intelligence start showing up in company earnings? We are so impatient in this country. So yes, companies are spending a ton of money on AI. Is it starting to make a dent in their earnings? Are we starting to get earnings increases because of it? With NVIDIA, it's easy because they're the ones who are selling the shovels, so to speak. So when you look back over time, you'll hear about the gold rush and they'll say, well, the people who sold the shovels were the ones who really made out during the gold rush. And that's the thing with the NVIDIA, is that you can't really do AI unless you buy their chips. So NVIDIA has had this huge influx of sales, and you really see it in their numbers. But when it comes to rolling it out to consumers, are you paying for AI? Do you have a subscription to Chat GPT, all of these things? So how are these companies going to make it to where they actually, it doesn't just make them more competitive, but it actually impacts their numbers? So that's something we talked about on a podcast a number of weeks ago, where I said, okay, when you look at like technological advances, is it something that's going to make the company more competitive, but they're paying for it and the consumers don't pay for it? Or is it something that is going to allow the consumers to or the companies to actually be able to charge consumers for, and it makes the company more profitable? So the jury's still kind of out on this for specific companies. I think that the best companies are going to figure out a way to make this happen. So obviously NVIDIA, they're selling the hardware that you have to have for this. That's also going to be true for maybe a company like Dell, who puts in the servers to be able to run the chips and kind of the infrastructure for AI. But as far as the consumer facing piece, I think of a company like Google right now, where they have Gemini that you can do searches, but you're not necessarily paying for it. So Google's paying the price, but they're not passing that price on to the consumers. So hopefully I'm saying this in a way that you can follow me. Microsoft is a little bit different. So Microsoft has been very, I would say, proactive. There's probably going to be some kind of hardware refresh where they're already working on computers. Microsoft always does, and historically has done, such a great job of making things simple for the consumer, right? So when you look back at the early days of the computer, they did a great job with Windows and being able to click on icons and making it simple for people to use. Well, they're looking and developing ways to do the same thing with AI, where there's going to be on your keyboard, there will be an AI button, a Copilot button. So Microsoft's AI is called Copilot. They're already putting it into Microsoft Edge, and where they're integrating it there and making it easy for consumers to be able to start using it. So with their tie into OpenAI. That looks to be able to continue, but with them, it's also their cloud services same thing with Amazon with their cloud services and being able to charge businesses to be able to, have all their data in the cloud, those kind of things. So there's going to be the business to business piece, and then there's also going to be the business to consumer piece, which is going to be paramount. But I just thought it was interesting, like, every single quarter, and we're about to hit earnings season again at the end of July. So every single quarter, analysts are looking for, okay, you've spent all this money on AI. Are you starting to see results? And so, how many more quarters can they go before analysts start dinging them on results? And I bring that up because we've had a serious run here in the market, and companies are doing well, but momentum is on the side of these companies. I mean, Microsoft started the year at $370 a share, and it's up to $467 right now. So we've had a huge growth in these companies. But over the last 3 to 5 years, it's been kind of weird with COVID and the 2022 rate increases and those kind of things. And so it has not been a traditional market by any means. And by the way, if you want to feel old, Amazon turned 30 years old on July 5th. So Amazon was actually started in 1994. And the first name of the company was actually not Amazon. It was Cadabra, which everybody called Cadaver, and they changed it when they were calling because it was too easily confused. So when you look at Amazon and their dominance, I bring them up not only because they turned 30 years old, because they actually just passed $2 trillion in market cap. And, this year they're expected to sell $554 billion worth of goods, which gives them a 42% share of e-commerce business, which is crazy when you look at Walmart, who still only has 6% of e-commerce business, even though Walmart is the United States' largest retailer. But you look at them, Amazon Web Services has done really well. It has 31% of the $300 billion cloud business. Prime Video is the fourth watched streaming service. And their new advertising business, which you might not even realize that all the advertising that people are paying for on Prime, on the Amazon website, is now third behind Alphabet, which is Google, and Meta, which is Facebook and Instagram and all those. But Amazon is actually third in that, which is pretty amazing that they've ramped that up. But I was watching a show on Prime the other day, and they did an ad in Prime, and I thought, man, I don't know how others are going to compete against this. But watching a show on Prime, they do an ad for Duracell batteries, and below it, you could actually click on it, and it had different battery packs that you could click on, and it would automatically add it to your Amazon cart. So, we're getting closer and closer to being able to watch something, see it on the screen, click a button, and have it shipped to you within the next, 24 hours, which to me is really, quite amazing. But also think about how much advertisers are going to be willing to pay for that kind of access to you and your wallet and your money, and really be able to really just take advantage of those impulse buys while you're watching TV. So what could be worse for your wallet, right? So great for advertisers, maybe bad for us. We're gonna have to be disciplined when it comes to that. So Amazon turning 30, market doing well. Again, with Microsoft and those companies, the PC refresh, are they going to add, adding Copilot to everything, Copilot subscriptions. So the other good thing about Microsoft is they're really good about doing subscriptions. So with Copilot, they're with enterprise businesses, the business to business consumers, they're going to start paying $30 a month for Copilot subscriptions, all of these things. And so I think that, even though the market might become impatient with how fast that they see the AI profits coming, I think it eventually will happen. But there is going to be some, there's going to be some trips along the way where things don't work out. So a couple episodes ago, I talked about how McDonald's was going to use AI to help them take the order of, people when they come through the drive-through. Well, they actually just halted that. I don't know if they've halted it for good, but they're retesting it because it was getting things wrong. Some customer ordered ordered some McNuggets and it charged them like $225 and it was inaccurate and things of that nature. So some of this is going to be stop and go a little bit, and we'll see how it actually ends up rolling out. But one of the other things I wanted to talk about was an article that came out that surveyed where wealthy older investors versus younger investors invest and how different they are. So this is an article that appeared in Yahoo Finance, and I got to preface it because it said that younger investors are deemed to be age 21 to 43, which I was happy with that because I'm 43, so I'm considered a young investor somehow. And older investors are age 44 plus. Okay, so younger 21 to 43, older 44 and above. And you had to have a minimum of $3 million in investable assets. So obviously, with the 21 to 43 range, it's probably going to be at the higher end of that age range. There's probably not a lot of 22-year-olds that have $3 million to invest. But what's interesting is how different they invest. So 21 to 43-year-olds, the top investment for them, 31% of their holdings are in real estate, which I found interesting. Actually, it's not the most interesting. Of the 21 to 43-year-olds that have $3 million or more to invest, only 14% of their investments were in U.S. stocks. Whereas for older investors, 41% of their investments were in stocks. And 32% for the older were in real estate. So real estate was second for the older, first for the younger. But where it really diverges is that, and for the younger investors, 28% of their investable assets were in crypto or digital assets. So right there, with the amount being, I can't turn my academic brain off, but 28% have it in crypto or digital assets. And remember, the criteria for this was you had to have 3 million or more to be considered for this study. So I wonder how much of this is skewed towards people who invested in maybe Bitcoin and stuff early on, and it brought their assets up to that level. So that's why they have so much in those assets. But I don't know. So I just think about those things. The next for younger investors is private equity. At 26%, personal company brand, like personal branding, 24%, direct investment into a company, which is interesting because private equity kind of does that as well. And then companies focused on positive impact is 21%. So the breakdown on this is kind of odd. And then bonds and U.S. stocks. Whereas for the older investors, it's much more, U.S. stocks, real estate, emerging markets, international equities. Private equity is much lower at 15%. Crypto is much lower at 4%. And so you get kind of the normal asset allocation for the 44 and above class. And for the younger generation, it's much different than kind of theoretical, historical asset allocation for portfolio building. Doesn't mean it's wrong at all. It just means it's different. And so I thought it was worth pointing out here because some of these would be difficult if you didn't have a large sum of money. They would be difficult to invest in. So private equity is not always easy for somebody that doesn't have a lot of money to invest in. The direct investment into a company normally is going to carry a minimum there. So I don't know. It's kind of odd. I would love to see what this looks like for somebody, people who have less than $1 million, but thought it was worth bringing up. The crypto digital assets definitely not going to be going away. I would love to see a breakdown of which ones they're actually in. I mean, I'm sure Bitcoin's a big piece of that, but if you didn't get in Bitcoin early, what are you investing in? So maybe I can look and see and find some more, I don't know, better article that has some more on that. So, because when you go to a place like Coinbase is where a lot of people are investing in digital assets, and you look at the crypto that you can invest in, there's 11,800 different cryptos that you can invest in. 11,800 different cryptos that you can invest in. And I mean, how are you? I have no idea how to be able to give you any kind of information on which of these are better or worse or whatever. But obviously, there is a lot of activity there. And Coinbase, kind of the selling of the shovels theory again, you can actually invest in Coinbase. Their symbol is COIN if you just want to invest in that, but it has been a rocky, it has been rocky to say the least. I mean, in 2021 they were $319 a share, and right now they're at $223. So they were at $319, they went down to $35 in 2022, and they've come all the way back up. So definitely not for the faint at heart. I mean, you have to be willing to ride this out just like crypto. So again, not financial advice. Talk to your financial advisor, all that kind of good stuff. And so as we get here to the end, and this is going to be a longer episode, as we get here to middle of the year, one of the things I want you to think about is what has happened to your financial goals for the year. This is a great time to reevaluate what you've been able to accomplish halfway through the year. So reevaluate your budget. Think about, what did you overspend on? What did you underspend on? There's some of us, I'm not going to call out names, but a lot of times we don't really want to look and see what we've spent money on because it puts it like in our face, right? So, but you got to look at it. You got to look and see what you spent money on. What did you do well? How much did you save? How much did you invest the first half of the year? How are your investments doing? Are you on track to hit your goals for the year? Are you not on track? Did something come out of left field that kind of threw you off? Can you readjust and get back on track? So look at where you maybe overspent, look at where you underspent or undersaved, adjust the budget, look and see, okay, what were my goals? Revisit your financial plan. Did you write your financial plan down? That is so key. So many people do not write their financial plans down. Only about 3% of people write down their goals, and there's just not that many people that actually write it down. So make sure it's SMART, right? So we talk about SMART goals, which many of you have probably already heard. That's SMART, measurable. Is it achievable? Is it relevant? And then is it time specific? So did you give yourself how much you want to save this year? All those kind of goals. Did you say how much you want to invest this year, and kind of check on those? And then also, did you pay down credit card debt? Did you increase your credit card debt? So we talked about an episode where credit cards have gone up on the amount of interest because interest rates have gone up. So you got to be careful with credit card debt, all of those things. And then again, in today's world, how many subscriptions do you have? So once a year, twice a year, do you look at the number of subscriptions that you have that are dinging your checking accounts? Are you actually using those subscriptions? Those little things where you might not notice those charges adding up. And individually, they might not add up to a lot, but collectively they can, and they can throw you off of your goals. So it's just a good time to reevaluate, look at things, see where you're at. I mean, even for me, my goals for the year changed. I did that whole episode where I purchased that commercial property. I did not factor that in. So it really threw off my investing goals, savings goals, because I shifted so much money into that purchase. It's not a bad thing. It just moved my goals around for the year. And so, I had to alter some things, change some things based on that. So it's not that the changes, normally the goals we set for ourselves, we might not hit them directly, but we just want to make sure that we're on the right track, right? So looking at kind of where you're investing and things of that nature. And so when you look at, some of the investments that you might be thinking about this next week, we're going to have the CPI data comes out, PCI data comes out. So if that data comes out where inflation looks like it's lowering, then that means that we're probably going to get an interest rate drop in September. And so that'll be right before the election and all of that. But, the market is looking pretty good. I mean, normally election years are more rocky, just more volatile. But because we've had Biden as president, we've had Trump as president already, the market and the consumers kind of know what the expectations are based on who's going to be in office. So we've had, honestly, for most presidential years, and I'm going to knock on wood here, it's been less volatile than it normally is. So we will see. We will see if that continues. That's definitely a conversation for another episode. But for this episode, make sure, again, look at your financial goals. What were your goals at the beginning of the year? Where are you today? Are there any adjustments that need to be made? And especially if your goal was to start investing, to invest more, to open up a Roth IRA, to fund your 401k more, those kind of goals, make sure that you're on track for those, because it makes a huge difference. It makes a huge difference. Again, starting your investment journey, getting on the dance floor, that is the biggest key. Setting things up to where it automatically invests for you, where it automatically transfers money. Those kind of things are so key, because it's really about, those little consistent, boring things that make such a difference in your life, whether it's financially or personally or just other goals that you have for yourself. And I thought it was there's a quote I want to end with today where it says, we often fixate on the visible and exciting, overlooking that most success comes from consistently doing the mundane, unglamorous work that few notice. The 98/2% rule. People spend 98% of their time talking about flashy things that contribute only 2% to the results, while overlooking the fact that 98% of the results come from consistently doing the boring basics that few notice. So spend time on the mundane, consistent, boring things that most people are never going to see. And that's how you win the day, win the week, win the month, win the year. And then at the end of 24, you say, man, I got a lot of stuff done this year. So as always, don't mistake activity for achievement, and I'll see you next time. Thanks, everybody.